How's it going, everyone? My name is Dan, but you can call me Malone, and today we're going to be discussing the question on every investor's mind. Where should I be investing my money? You might have heard that the S&P 500 locked in its longest series of all-time highs since 1997. Meanwhile, in the property markets, a recent analysis from UBS shows that property prices have been increasing pretty much everywhere. So clearly there are some great returns being made in both stocks and real estate, especially when compared to the non-existent returns offered by the likes of bank savings accounts. But for both investing newcomers and veterans alike, the question isn't whether you should invest, the question is where. Sure, you could invest in blue chip stocks like Apple or Disney, but what if your money will be better suited to the likes of physical real estate? So to answer the question of where you should or could invest your money, we're going to be taking a look at the considerations to be taken on board when investing in stocks or real estate. Your job as an investor is to craft an investing strategy which makes sense in the context of your own personal circumstances. Investing is not one size fits all. What works for one person will not always work for another. So you really need to understand all of the various options available to you in order to make an informed decision. We like informed decisions because they're not normally made on the basis of emotion and emotion alone. But before we get started on today's video, if I could ask that you take 2 seconds out of your day to leave a like, and if you are new around here, don't forget to subscribe. Let's first begin by discussing how we make money with stocks and real estate. Most investments earn a return in one of two ways, or indeed through a combination of both. These are capital appreciation and income payments. Capital appreciation represents an increase in the value of our investment. In simple terms, the price of the stock or property today exceeds the price we originally paid when we first purchased it. This is oftentimes referred to as an unrealized gain. We refer to this increase in value as being unrealized because although it exists on paper, it does not represent real money in your pocket because it has yet to be sold. If you were to sell that investment at that point, that gain will become a realized gain. Capital appreciation for both stocks and property is fairly self-explanatory and for all intents and purposes operates in the same manner. You make an investment and the value of that investment can increase or decrease over time. The same principles apply to decreases in the value of your investment. These decreases are referred to as unrealized losses up until the point at which they are sold and subsequently become realized losses. The key point here is that with all investments, when we're talking about increases and decreases in value, we only truly make or lose money at the point at which the investment is sold. The intervening holding period is irrelevant. It can be risky to only hold investments whose return is solely reliant on the subsequent sale of the investment. The reason why is because until you physically sell the investment, you've made no money, irrespective as to whether or not you're sitting on a gain. That gain could be wiped out overnight and you would have nothing to show for your investment. This is where income payments come in. Income payments serve as a regular form of realized return from your investments. Instead of relying on the value of your investment increasing and subsequently selling that investment to earn a return, income payments allow you to receive a steady stream of cash from your investment while also continuing to hold the investment, i.e., you don't have to sell the investment to earn a return. With respect to stocks and property, income payments normally come in the form of dividends and rent, respectively. Starting with dividends, a key concept to understand is that when you purchase the stock of a given company, you become an owner of that company. Being an owner of a company comes with its benefits, one of which is the entitlement to share in the profits of the company. In some cases, but not all, shareholders will be rewarded through a dividend payment, which is a distribution of the company's profits. Some companies prefer to not pay a dividend and to instead reinvest that cash back into the business in the hope that it will add greater value to the shareholders' investment. Companies like Tesla won't pay shareholders a dividend because their focus is reinvesting business profits back into the company to grow its operations. Whereas companies like McDonald's like to pay their shareholders a dividend because they may have enough excess cash to do so. In the case of real estate, income payments typically come in the form of rent. You, the investor, will purchase a property and subsequently let that property out to tenants. The tenants, in return for occupying the property, pay you rent. Rental income from property investing is a concept that most of us are more than familiar with, because I'm willing to bet that a lot of you watching are tenants yourselves. So our first consideration when looking at investing in stocks versus property is liquidity. Now, when we talk about liquidity, or how liquid an investment is, we're talking about how easy it is to convert that investment back into cash, i.e. how easy it is to sell the investment should we need or want to. Liquidity is very important for us as investors for a number of reasons, but the primary reason, in my opinion, is cash management. It's always recommended that before you invest, you should have a pool of money set aside in an easily accessible bank account in case of emergency. This is oftentimes referred to as an emergency fund or rainy day fund. The purpose of an emergency fund is to ensure that you're covered in the event of a sudden need for cash. You don't want to be left in a scenario where all your money is invested and you have to sell some of those investments to access some cash. This could lead to tax implications, or worse yet, you could be forced to sell those investments at a loss. But we don't always get this right, and sometimes we may have to sell some of our investments to access cash. Generally speaking, stocks are very easy to buy and sell. There's lots of buyers and sellers available at any given time, so converting your investment back into cash shouldn't be an issue. Nowadays, we use online brokers like DEGIRO and Book0 to buy and sell stocks, so we literally have this capability at the touch of a button. Compare this to real estate, which is considered to be illiquid. Buying and selling a property is an arduous process and typically requires the involvement of solicitors, independent valuers, and real estate agents. Not to mention that the number of buyers and sellers for physical real estate is going to be much lower than stocks. This can make it difficult to realize your investment return and get your cash out of the property. Our second consideration is cost. Keeping your costs low is critical to your investment returns, both in stock and property investing. Investing in stocks nowadays is very cheap and accessible, making it a low-cost investment option. Companies like DEGIRO, Book0, and Trading 212 are competing for your business. This is good news for us as investors, because healthy competition not only results in improved customer experience and a better product, but it also results in lower investing costs. Vanguard, one of the leading investment managers in the world, provide us with a great example of how high costs can eat into your investment returns. They give the example of investing $100,000 into an investment which earns 6% each year for the next 25 years. Now, if there were no costs or fees, that investment would grow to about $430,000. But if you paid just 2% each year in costs, your investment would only grow to $260,000, which is 35% lower. Luckily, the cost of investing in stocks is falling each and every year, which is good news for your investment returns. Real estate investing is a bit more complicated when it comes to cost. First of all, there's lots of hidden costs associated with buying a property, namely solicitors' fees, taxes, valuation fees, and insurance. All of these initial costs eat into your ultimate investment return. Secondly, there's the costs incurred on an ongoing basis, the most obvious of which are the mortgage payments. It's unlikely that you'll be able to purchase an investment property outright in cash, and therefore you'll need the assistance of a lending institution such as a bank. The cost of the mortgage is the interest payments which you pay to the lender. The higher the mortgage and the higher the interest rate attached to it, the higher your cost is going to be. Other ongoing costs include any repairs and maintenance that the property needs. This is why it's so important to choose the right tenant, because if they damage the property, it's going to cost you money and eat into your returns. It's obviously a lot more expensive to invest in property than it is to invest in stocks, in the sense that property investing requires a much larger initial investment. You can buy a share in Apple for $150, but to invest in an investment property, using Ireland as an example, you would require a deposit of 30% of the value of the property. So for a property worth €300,000, you would need to put down €90,000 in order to obtain the loan necessary to bridge the gap. This makes real estate investing far more inaccessible to the average investor as compared to stocks. Our third consideration is volatility. When we talk about volatility, we're talking about how much the price of an investment will vary over time. Highly volatile investments have the potential to increase and decrease in value quite significantly, whereas less volatile investments won't see the same kind of drastic movements. As a rule of thumb, stock investing is much more volatile than real estate investing. The value of any stock on the stock market can increase and decrease at a rate much faster than physical property. But with that being said, cities like Toronto have seen property prices almost double over the last 10 years. The point is that it's a virtual certainty that your stock portfolio will be much more volatile than any property investments you make. But that's not to say that all stocks have equal levels of volatility. They don't, and the same goes for physical real estate. From your perspective, you need to make sure that the investments you make align with your tolerance and attitude towards risk. For example, if you are uncomfortable with the idea of sharp increases and decreases in the value of your investment, you wouldn't invest in stocks which have a tendency to do just that. But let me make this crystal clear. You need to be comfortable with your investments falling in value to a certain degree if you're planning on being a successful investor. It's simply not reasonable to expect that you'll put money into investments and that money will then grow indefinitely. Successful investing boils down to making informed investment decisions and being able to stand by those decisions even when things aren't going your way. One extra consideration under the heading of volatility is that real estate investing involves leverage. When we talk about leverage, we're simply referring to an investment which is being made using debt, either in full or in combination with our own money. Leverage is a very powerful tool because it has the ability to amplify any gains made on an investment. But equally, leverage can also amplify any losses incurred. The best way to explain this is by using an example. Let's say we invest 400,000 euro into a property. Let's also say that of this 400,000 euro investment, 100,000 euro relates to our own cash, also known as the equity portion, and 300,000 euro relates to borrowed cash, also known as the debt portion. In this circumstance, we have a borrowing level of 3-to-1, i.e. for every 3 euro of borrowed cash, we've put up 1 euro of our own cash. So what happens when the value of this investment falls by 20%? Our 400,000 euro initial investment is now worth 320,000 euro, which is a reduction of 80,000 euro, i.e. 20%. However, the reality of this situation is far more sincere. We had initially put up 100,000 euro of our own cash to fund this investment, and the rest was funded using borrowings of 300,000 euro. Irrespective of how the investment performs, we're required to repay that 300,000 euro plus interest. So in reality, while the value of the investment might have fallen by only 20%, the monetary impact of the 80,000 euro dip has reduced our equity portion, i.e. the portion of the property that we personally own, by 80%. So a 20% investment loss has been amplified into an 80% real loss. The same concept will be applied to a 20% gain, which would be amplified into an 80% real gain. So in volatile property markets, the use of leverage has the potential for both significant gains and losses. The fourth consideration is diversification. When we talk about diversification, we're talking about not having all your eggs in one basket. Just like how you could spread out your investment across different asset classes like stocks, bonds, cash, crypto, derivatives, and real estate, you could also spread out your investment within each of those asset classes as well. One of the best things about investing in stocks is the ease at which you can diversify your portfolio. The best part is that online brokers like DeGiro and BookZero are constantly expanding their offering in terms of which stocks you can invest in. Better yet, you can own lots of different stocks within a certain index, sector, or market by using a low-cost product like an ETF or exchange-traded fund. The point here is that because stocks have a low buying cost and are highly liquid, it's quite easy to make a well-rounded investment portfolio and to rebalance that portfolio as you go. Real estate investing, on the other hand, has high buying costs and is illiquid, making it quite difficult to diversify your real estate portfolio. Real estate investors will normally look to diversify their investments through a combination of both commercial and residential property. However, because leverage is involved, a successful property investor will find it easier and easier to diversify and expand their portfolio over time, provided they're making profitable transactions. But at the beginning, it can be risky putting a large deposit down on one single investment property, and so by definition, you'll have all your eggs in one basket. Now, of course, stocks and property don't have to live in isolation from each other. In fact, having a portfolio which includes a combination of both stocks and physical real estate, among other asset classes, is definitely a preferable choice when it comes to diversification. If you're looking for the best of both worlds, you could invest in a real estate investment trust, better known as a REIT. REITs are publicly traded on the stock exchange, and their business model involves taking money from lots of different investors and using that money to purchase a portfolio of investment property, or alternatively, using that money to finance real estate through mortgages. The best part about REITs is that they give you access to the benefits of physical real estate investing, namely a regular source of income via dividends. All the while, you don't have to worry about managing the physical property yourself. You simply invest and collect your dividends each quarter. The fifth and final consideration is tax. Now, I know for a lot of people, the idea of having to pay tax and file tax returns is almost enough to put them off investing altogether. But tax is just part and parcel of being an investor. If you're paying tax, it means you're making money, which is obviously a good thing. But of course, you should do everything in your power to minimize your tax bill within the letter of the law. When it comes to stocks versus property, there are some differences in tax to be aware of. First of all, a lot of tax systems worldwide will encourage buy-to-let properties, and the reason why is quite straightforward. Most countries worldwide are facing increasing pressure on housing supply, and this is especially true in Ireland. There isn't enough homes being built to match demand, and so the government will reward individuals who are willing to rent out properties by giving them attractive tax incentives. These tax incentives are going to be different depending on where in the world you live, but they normally include income tax exemptions or reliefs for rental income and capital gains tax exemptions or reliefs for realized gains. Stocks, on the other hand, tend to have less favorable tax treatment as compared to property. The exception will be for entrepreneurs and business founders who have successfully scaled their companies and are now looking to exit those companies. Generally, the tax system will reward them with certain capital gains exemptions or reliefs. But for most investors, capital gains and dividends arising from stock investments are going to be taxed quite heavily. The last point to mention here would be on private pensions. Stocks and retirement planning go hand in hand. Most private pension products, be it a personal retirement account that you can manage yourself or a series of pension funds which you can invest into, generally offer the ability to invest in stocks. It is certainly possible to invest in real estate through your pension, be it directly or indirectly, but you might find that the cost of doing so is much higher as compared to investing in stocks. So if you wanted to avoid paying tax on your capital gains and dividends arising from stocks, while also getting very attractive tax relief simultaneously, placing such investments into a private pension is a no-brainer. In conclusion, both stock investing and real estate investing both have their own merits. Stock investing is accessible, low cost, and liquid. Real estate investing has lower volatility, greater tax benefits, and can serve as a good hedge against inflation. Both options have their own set of risks, some of which are not mutually exclusive. Overvaluation in the stock market is quite common, especially among growth stocks, which is cause for concern in the long term with respect to future investment returns. Therefore, while an investment in the S&P 500 in April 2020 would have provided you with a very healthy return today, we don't know what the future holds, but then again, we never do. Likewise, while the UBS research, which I referenced at the beginning of the video, indicates that property prices prices are increasing virtually everywhere, some areas are heading into overvalued and bubble territories. Remember, because real estate investing utilizes leverage, any significant falls in the valuation of the property is likely going to wipe you out, and that's a risk factor which must be considered. For the average investor, I think it's fair to say that stock market investing is going to be the right play. Not necessarily investing in individual companies, but even the likes of low-cost ETFs. The reason why is because the average investor simply doesn't want to put in the time to carry out the necessary due diligence for either stock market or real estate investing, and that's fair enough. The goal of investing, in my eyes, is to achieve an investment return which at least outpaces the rate of inflation and protects the value of your initial investment. And if that can be achieved using ETFs, then that's totally acceptable. But at the end of the day, personal finance is personal. You need to make the investment decision which makes the most sense in the context of your own personal circumstances and your short, medium and long-term goals. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.